So you're planning to retire before you'll begin receiving Social Security benefits. As a result, you want to take more out of your investments in the early years of retirement. And then eventually, once you start claiming Social Security, the amount you take out of your investments will, of course, come down. And your big question is, how do I figure out if this plan will work? How much more, say, than the 4% rule would suggest, can I take out when I start retiring, knowing that a few years down the road, Social Security will make up that difference? That's the question we're going to try to answer in today's video. Hey everybody, my name is Rob Berger. This is the Financial Freedom Show, and I can't tell you how many times people have asked me some variation of that question. I'm going to spend more than 4% in year one, but whatever, 3, 5, 10 years down the road, Social Security will kick in. That will lower my withdrawal percentages from my nest egg. How can I figure out if this will all work out? I'm going to actually show you 3 different tools you can use to try to model that very scenario. If you're new to the channel, this is not a get-rich-quick channel on YouTube. No, this is a do smart things with your money, build wealth, and have a good life kind of channel. So if that's of interest to you, I encourage you to subscribe. I also send out a weekly newsletter Sunday mornings. You can subscribe to that with the link below the video. All right, enough chit chat. Let's get right to it. The first tool I want to show you, and by the way, the first 2 are free. The third one, a really important tool, but it costs some money. Not a lot, but some money. Anyway, so this is the first of the 2 free tools. This is FiCalc App. We've actually looked at this tool in the past. It helps you model different withdrawal strategies, but we can use this to sort of model the very scenario we've talked about. So I'm going to assume, just for our sake, obviously you'll put in whatever is relevant to you, but I'm going to assume a 30-year retirement, an investment portfolio of $1 million. Let's assume, we'll assume 60% in equities, 40% in bonds, and nothing in cash. And notice there are annual fees here. They're set very low for equities and bonds. This assumes sort of an index fund investing. But if you have actively managed funds or you pay an advisor 1%, you got to change these fees here because they will have a huge impact on the results. All right. So we've just set it up. We've selected as our withdrawal strategy what's called constant dollar. That just means the amount we take out gets adjusted each year by the rate of inflation. This would be the 4% rule kind of strategy that Bill Bengen popularized with his 1994 paper. Now, we haven't put anything in here yet about Social Security. We still have the withdrawals at $40,000 in the first year. That's 4% of $1 million, of course, adjusting for inflation. Before we factor in Social Security, let me just show you how this works. You'll see that this is all based on historical data going back to 1871. It basically looks at, in this case, 30-year retirement periods beginning in each year, 1871 all the way up to the present. And it says, well, 95% of the time, you don't run out of money. And we can actually see this here. Again, we've got 1871 all the way down here, and it goes up to 1992 because that would be the last year in which we could now have 30 years worth of data since we're in 2022. The colors are significant. Blue means that at the end of the 30 years, your final year portfolio was actually 300% higher than your starting portfolio. Red means you ran out of money. And yellow means you didn't run out of money, but things got kind of difficult, and you ended up with a portfolio that was less than 35% of your initial portfolio. We can drill down into any one of these just by clicking the year. So we'll look at a good year. Who wants to look at a bad year? We'll look at a good year, 1983, and you can see this is the portfolio balance over time on an inflation-adjusted basis. So you're still taking your money out every year, but you end up 30 years later with $4 million. You can actually download this data right here. It says download as CSV, and it gives you more data than what's on the screen. It gives you both inflation adjusted and just nominal dollars. So that's how that works. And then we can click this link here to go back and look at a different year if we want to. All right, so now how do we model this scenario where we're going to spend more than, say, 4% in year one, but Social Security will kick in down the road? So the first thing we have to do here is decide how much we're going to spend. So we'll just throw in, we'll throw in 60,000. So that'd be a 6% spending rate to begin with. Of course, just if we just did that alone, you can see the success rate drops to almost 50%. And we scroll down, we got a lot of red, right? And that just tells us that on a constant dollar withdrawal strategy, starting with 6% fails, well, about half the time. So, but we now have to factor in Social Security, We can do that with what's called additional income, and we can just click this add additional income button and give it a name. Well, I guess we'll call it Social Security, but this could be a pension, could be an annuity, whatever. And here you have to put the annual amount in. Of course, that's going to vary from person to person. I'll just throw in $25,000 a year. And since it's Social Security, I am going to adjust it for inflation because we do get those COLA adjustments every year. And then here is where you put, when does it start? And so, it depends on your scenario, but we'll assume you're going to retire. We'll assume at 60. And for this scenario, you're going to wait until you're 70, the maximum. So we'll wait 10 years. And then it repeats indefinitely, right? Because it continues until we pass away. And there we go. We can add that income. Now, what's it do? Well, our success rate does go up significantly from 51% to 81%. Now, if we go down to the years, though, we see that there's still a lot of red, and there's more yellow as well, and fewer blues. But this gives us at least some idea. Now, keep in mind, I like to think of it not as a failure rate, but really more, what's the probability you'll have to adjust your plan? And so in this scenario, 81% of the time, you wouldn't, in theory, have to adjust your plan. I say in theory because some of these got pretty slim, as the portfolio goes down and down and down as you're getting closer and closer to, in this scenario, it's 90. Yeah, it may theoretically work out, but it may not be a very comfortable way to live. So I think, your chances of adjusting your plan are probably greater than what this suggests. But there you go. That's the data. And it gives you a sense as to how this has worked out based on historical data. And of course, we can make changes to this. We can come in here and say, well, we're actually going to retire not at 60, but at 62. And so we're only going to go 8 years until we get Social Security. And how did that change it? Well, it went from 81 to 89. And we can obviously go in here and look at all the details we want. By the way, you'll notice through all these scenarios, the mid to late 60s were a pretty rough time to retire. Of course, we can come in here and say, well, I don't think we need 60,000, 57,000 actually will do it. And if we do that, it adjusts it some more. Now we're up to 95%. So that's basically how the tool works. And again, you can model not just Social Security, but a pension, annuities. There's also a section where you can model expenses. Maybe you want to take a trip around the world that's going to cost $10,000 when you're 65. You can put that in as well. So that's the first tool. Highly recommend it. Totally free, easy to use. All right, let's take a look at the second one. This also is free. I've talked about it many times. This is Personal Capital. This is a demo account, and these are just made up accounts that I've put in here over time. So the idea with Personal Capital is you link your accounts to Personal Capital. It brings in all of your data. So unlike with FiCalc, there's no linking of your accounts. Here you can link your accounts if you want, and that way it has actual data, and you can watch this plan change over time. And for the plan itself, you'd go to Planning and Retirement Planner. And I actually started to put one in here. You see I've set this hypothetical person to be 60 and retiring at 60. That's what that little palm tree means right there. I gave him my name, but this isn't my situation. And assuming, again, I wanted to assume 30 years, so I assumed for planning purposes at 90. You can change all of that, of course. You can go to Edit Assumptions. You can change the assumed inflation rate, which I realize I've got at 7%. Not a bad rate by today's standards, but probably maybe a little high for an assumption. We'll put it down to 40%. 4%. Hope it never gets to 40. You can change the effective tax rate. You can change your life expectancy. And the thing that I like about this that's different than FiCalc is that it uses Monte Carlo analysis, which means it's kind of running through thousands of potential scenarios that could happen. And so it's not that historical data versus Monte Carlo, one is better than the other. I think they're both good approaches to understanding a retirement plan. I like to use them both. So with FiCalc, you get historical data. With Personal Capital, you get Monte Carlo analysis, and you can compare scenarios. I haven't done that here, but you could have a scenario where, for example, in this one, I'm assuming we get Social Security at age 66. You can change that here, but what you could also do is just create a compared scenario and set whatever assumption you want, and then compare the two. So I like that feature of Personal Capital as well. And of course, You can add other income or spending events here as well. You can also change your assumed monthly spending here. So that's personal capital. Again, I think at a minimum, FiCalc and personal capital, I would definitely use them. They're very easy to use. They're free, and they give you a good sort of back of the envelope idea of as to how your plan will work out, again, based on historical data and Monte Carlo analysis. Now, if you want the Cadillac of financial planning tools when it comes to retirement, the answer is New Retirement. Now, this is a paid tool, but very reasonable. It's something I use. Here it is. Again, this is a demo account. This is not my account. I will say this about it. You can get up and running with FiCalc and personal capital in a couple of minutes and have some data to look at. This is going to take hours. It's going to take some time to learn the tool, watching some videos that they offer, understanding all of the data, but it's worth the investment. Unlike the first two tools, this will cover just about every aspect of retirement. So you go through all of your accounts, and we can expand this. Again, these are just made up. You can link your accounts to New Retirement. Honestly, I think just manually entering them is fine. But you'll put in whether it's tax advantage, Roth, or traditional. Is it an HSA? Is it taxable? You'll go through home and real estate. You can model future purchases. Maybe you're going to buy a second home, or maybe you're going to move to a different state with different tax rules. You can model all that. Of course, they have information for debt. They have information for income, including Social Security. And so you can have for you, a spouse, and you can edit all of this. And we'll actually show you another tool they offer in a minute. But very robust. You put in here when you're going to claim your Social Security. It breaks out expenses, including medical and Medicare. They have a very robust tool to help you estimate your Medicare premiums. You can always do an itemized version of this as well. I was surprised, by the way, just how big these numbers get over a lifetime. And then from there, you can just see how your money is flowing each year based on withdrawals, whether they're from savings drawdown or RMDs, estate planning. And the tool, as you can see, goes on and on. It really covers everything that I can think you would want to consider in a robust retirement plan. Now, specific to Social Security, if you come down here to, I think it's Explorers, yeah, they have what's called a Social Security Explorer. And this is a pretty neat tool. It walks through some basic information, but if we'll just click through these quickly, you'll want to know what your benefits are. So go to ssa.gov, you can get your Social Security statement, you can fill in this data. I think I just threw in some numbers here. You can go through some assumptions, including longevity. And then it looks at different claiming strategies. This is the current plan that I, again, just sort of threw into this demo. Here's a desired claiming strategy that it's recommending. And here's a strategy if your goal is to maximize your benefits on the assumption you're going to live much longer than, say, life expectancy tables might suggest. It goes right into how much monthly income you're going to get and how those benefits are likely to change over time. And then it shows you a lifetime number based on the different strategies, and then gives you a summary, and then you can actually incorporate with the click of a button each of these strategies into your plan, and of course then see how it's affecting your overall retirement readiness, which, by the way, they also use Monte Carlo analysis and give you a percentage chance of success. And again, you can go into all kinds of detail into that and all of the assumptions that underlie it. So there you go. A very robust tool. I like it a lot, New Retirement, but again, you're going to want to roll up your sleeves. It's not going to be like 5 minutes and you have an answer. That one is much more in depth. I think probably ideal for those that are pretty much, okay, yeah, I'm going to retire maybe in a year, maybe 2, or I'm in retirement. I really need to know all these details. If you're out from retirement more than that, frankly, I think FiCalc and personal capital are probably more than enough just to get a rough idea of where you stand. So there you go. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.